Go.
Yeah.
Hi, my name is Scott Pappas, and you're watching the True Wealth YouTube channel. First, from our attorneys, this material is for informational purposes only, and any references to a particular investment or investment strategy are neither an offering nor solicitation to purchase any particular fund or securities. Any offer regarding private securities may only be made to qualified investors by means of delivery of a confidential private placement memorandum. Past performance is not necessarily indicative of future results. So one question I get is, why should an investment portfolio contain private equity and real estate? Well, the answer is this. Diversifying an investment portfolio is a fundamental strategy for managing risk while seeking to maximize returns. Private equity and real estate are two asset classes that offer unique benefits different from stock and bonds that make them valuable components of a well-rounded investment portfolio. So private equity, what is it? Private equity involves investing in private companies or buying out public companies to delist them from stock exchanges, which provides opportunities for significant returns in some cases. It allows investors to be involved in growth and transformation of companies through active management and operational improvements. Private equity often targets undervalued or promising sectors, potentially yielding high returns compared to traditional investments such as stocks or bonds. Further, private equity investments typically have lower correlation with the public markets, offering diversification benefits and reducing overall portfolio volatility. Real estate, on the other hand, can often provide tangible asset value and can generate steady income through rental yields while offering potential appreciation over time. Real estate investments can hedge against inflation, as property values and rents typically tend to rise with inflation, which preserves purchasing power. Moreover, real estate's performance often correlates differently with economic cycles compared to stock and bonds, enhancing diversification and stabilizing returns in an investment portfolio. Both asset classes, real estate and private equity, have historically outperformed traditional equities over the long term, offering potential for higher returns. However, they typically require longer investment horizons and may involve higher fees and less liquidity, which should be considered when allocating assets. So incorporating private equity and real estate into an investment portfolio not only enhances diversification due to their different risk-return profiles, but they also tap into growth potential and income generation that's often not available through conventional investment vehicles such as stocks and bonds. So one question I often get asked is, why do large university endowments such as Yale Endowment and the Harvard Endowment incorporate real estate and private equity into their portfolios? So large endowments such as those of Harvard and Yale incorporate real estate and private equity into their portfolios as part of a diversified investment strategy aimed at achieving strong risk-adjusted returns. The substantial assets managed by these endowments require a sophisticated approach that balances growth, income generation, and risk mitigation, and both real estate and private equity align well with these goals. So first, real estate investments offer several advantages that make them attractive to large endowments. By investing in property, endowments can access a mix of capital appreciation and income generation through rental yields. Real estate typically provides a hedge against inflation, as property values and rents tend to rise with inflation, preserving or even increasing the value of the endowment. Additionally, real estate investments diversify risk, since their return patterns often have a low correlation with traditional asset classes like stocks and bonds. This diversification will stabilize the overall portfolio, protecting it from volatility in public markets. Moreover, real estate investments are often illiquid. Now, this may seem like a disadvantage on the surface, but large endowments with long investment horizons view it as an opportunity. The liquidity premium associated with such investments means that they might deliver higher returns in exchange for lower liquidity positions, which these endowments can comfortably afford to maintain due to their size and perpetual investment horizon. Private equity, on the other hand, offers a potential for enhanced returns that many traditional public market investments might not provide. By investing in private companies, endowments can capture value at various stages of a company's lifestyle, from growth capital to leveraged buyouts and venture capital. These investments leverage the endowment's capacity to commit capital for longer periods, thus benefiting from the value created as the private companies grow and eventually hit exit through IPOs or acquisitions or divestments. The Yale University Endowment, notably under the leadership of David Swensen, popularized the endowment model, which emphasizes diversification, including significant allocation to alternative assets like private equity and real estate. These asset classes offer potential for higher returns due to their active management and the inefficiencies presented in private markets, which skilled managers can exploit. The theoretical underpinning is that private equity allows the endowment to partner with high-performing managers who can influence operational improvements, strategic direction, and financial restructuring of portfolio companies, aiming for outperformance over public equities. Additionally, both real estate and private equity can benefit from an illiquidity premium, offering higher potential returns due to the longer-term, less liquid nature of the investments. Such strategies align with the specific goals of university endowments, which often focus on growth to support long-term institutional needs such as scholarship, research funding, and infrastructure improvements. In summary, the inclusion of real estate and private equity in large endowment portfolios offers a mix of diversification, inflation hedging, potential for higher returns, and the ability to leverage long-term investment horizons to capture illiquidity premiums. This balanced approach supports the endowment's dual objectives of preserving capital and generating substantial returns to sustain and enhance university programs and operations over the long term. So one question I get asked often is, why do university endowments and large investors incorporate private equity and real estate into their portfolios? Well, the answer is this. University endowments and large investors often include private equity and real estate in their portfolios for several reasons. The first reason is the potential for higher returns. Private equity real estate investments have the potential to make more money compared to some traditional investments like stocks and bonds. This is because they often involve buying, improving, and selling properties for a profit. The second reason that endowments and large investors add real estate and private equity into portfolios for diversification. These investments in private equity and real estate often add variety to the portfolios, basically. By spreading out the investments, the portfolios can reduce the risk of losing money. If one type of investment isn't doing well, others might be doing better. A third reason why endowments and large investors add private equity and real estate into portfolios is inflation protection. Real estate values and rents often go up with inflation. This means that investing in real estate can help protect the money's purchasing power over time. And a fourth reason that large institutional investors and endowments add private equity and real estate to portfolios is to access exclusive opportunities. So private equity and real estate often involve deals that aren't available on public markets, like unique buildings or properties. This can provide opportunities for better returns. So by including private equity and real estate into an investment mix, these large investors aim to make more money, lower risk, and protect their wealth over time. No guarantees that they do it, but historically, it's proved to be an effective strategy. How can an investor with a large sum of money, let's say $5 million or more, can incorporate real estate and private equity into their portfolios? Well, incorporating real estate and private equity into a portfolio is a common strategy for investors that want to seek diversification, seek the potential for higher returns, and get exposure to different asset classes. The strategies to invest in real estate. One is direct ownership. Direct ownership of different types of properties, for example, residential properties. So investors can consider buying residential rental properties in areas with strong economic growth and rental demand. Basically, wherever the jobs are, the rents and the economic growth tend to follow. This includes single-family homes, duplexes, or small apartment buildings. Another way to invest in real estate directly is buying commercial properties. An investor may want to invest in office buildings, retail spaces, or warehouses, for example. Commercial real estate can offer higher income potential, but it comes with additional risk and requires more expertise. A third strategy is through vacation rentals, so direct ownership of vacation rental properties. So this is where an investor acquires properties in tourist-heavy areas, and they use platforms like Airbnb or VRBO to manage short-term rentals. Another way to access real estate is indirectly by buying REITs, real estate investment trusts. So investing in publicly traded REITs is a way to gain exposure to real estate markets without direct property management and responsibilities. REITs provide liquidity as they can be bought and sold like stocks on the stock market. A third strategy for investing in real estate is crowdfunding. Platforms like Fundrise or Realty Mogul allow investors to participate in larger commercial or residential projects with smaller capital commitments compared to direct ownership. This option provides diversification across multiple properties with minimal management responsibilities. There are risks involved, and they're not for everybody. A fourth way to get access to real estate in your portfolio is through real estate partnerships or syndications. Investing as a limited partner in real estate or in real estate syndicates where experienced operators manage large-scale projects. These investments can target specific property types like multifamily apartments, office buildings, or development projects. So what are ways to get private investment into a portfolio? Well, one is through direct investment of private companies. This involves directly investing into private businesses, which often requires substantial due diligence and a hands-on approach. This is not for everybody, to say the least. It should only be done with those people or companies or endowments or investors that have a focus on a specific industry and have great knowledge and expertise in that in real estate and in that sector. So another way to incorporate private equity into a portfolio is to invest in private equity funds. This is perhaps the most common way that an investor with $5 to $10 million can incorporate private equity into a portfolio. So to invest in private equity funds, you commit a portion of your capital to private equity funds that are managed by professional fund managers. These funds pool capital from multiple investors to buy stakes in private companies. Now, the different private equity strategies might focus on a specific strategy like buyouts, growth capital, or venture capital, and some private equity funds can put the entire mix of those in there. So another strategy to invest in private equity involves venture capital. And that's where, with venture capital investing involves investing in startup companies. Early stage companies often carry a high risk, but offer probably the most potential for high rewards. Another way to access private equity is through secondary market transactions. This involves purchasing equity stakes in private companies through secondary markets where existing investors sell their interests, generally to private equity secondary fund managers. This can provide liquidity options for entry into established businesses. So what are some considerations if you are considering adding real estate or private equity into a portfolio? First is diversification. You need to ensure a good mix of real estate and private equity, balancing risk and matching your investment timeline and liquidity needs. Another consideration is risk tolerance. Real estate offers tangible assets, typically with more stable income, while private equity can provide high growth, but is riskier oftentimes and less liquid. Another consideration is liquidity needs. Direct property ownership and private equity are less liquid compared to REITs or other publicly traded equities. So consider your cash flow needs closely when deciding to invest in private equity or real estate. Another consideration is expertise in management. You need to determine how involved you want to be in the management of these investments. Additionally, you can need to see whether you have the expertise to get involved with managing the investments or if it's better left to professionals. Professional advisors or managers can be beneficial for real estate portfolios and private equity funds to help you navigate the complexities and market dynamics in these asset classes. Another consideration in investing in private equity or real estate is due diligence. Thoroughly research and understand any investments that you're thinking of committing to, whether it's a direct investment, whether it's investment into a real estate or private equity funds, or whether it's through crowdfunding platforms. I can't underestimate the importance of due diligence in being able to research and understand any investment that you commit to. So in conclusion, by thoughtfully allocating a portion of your portfolio into diversified real estate assets and private equity assets, you may be able to achieve a balanced portfolio that takes advantage of the unique benefits each of these asset classes offer. So if you liked any of the content in this video, don't forget to like, subscribe, and share it. Thank you.